Welcome to our US dollar to Japanese yen analysis report covering September 22 to 27, 2025. In this presentation, we'll examine recent price movements, key news events, technical levels, and trading recommendations for the US dollar to Japanese yen currency pair. Our analysis incorporates data from multiple trusted sources including TradingView, InvestingLive, Action Forex, Forex.com, and Daily Forex to provide you with comprehensive insights for your trading decisions. Looking at the market overview, US dollar to Japanese yen closed the week at 149.472, with a daily change of -0.318 or -0.21%. The pair traded within a range of 149.403 to 149.957. Performance metrics show mixed results with a positive 5-day change of plus 1.03% and a monthly gain of plus 1.41%. While the year-to-date performance remains negative at -4.98%. The price chart reveals significant upward momentum during the week, with the pair breaking out of its previous consolidation range before encountering resistance near the psychologically important 150.00 level. Three major news events dominated US dollar to Japanese yen trading this week. First, stronger-than-expected US GDP data boosted the dollar, reducing expectations for future Fed rate cuts. Markets now discount fewer than 50 basis points of additional easing in 2025, down from nearly 100 basis points a month ago. Second, Japan's Tokyo CPI inflation eased to 2.5% year-over-year in September, reducing pressure on the BOJ to raise rates. Third, despite the Fed's recent 0.25% rate cut, the substantial interest rate differential between the US and Japan continues to support US dollar to Japanese yen through the carry trade mechanism. From a technical perspective, US dollar to Japanese yen is showing increasingly bullish signals. The pair is approaching a golden cross formation with the 50-day EMA at 147.32 about to cross above the 200-day EMA at 148.56. Key support levels include 149.00, 148.55, and the more significant 146.00 to 146.30 zone. Resistance levels to watch are 149.90 to 150.00, 151.22, 61.8% Fibonacci retracement, and 152.00. Technical indicators are moderately bullish with RSI at 58.3 and MACD showing positive momentum after the recent breakout from the consolidation range. For short-term traders with a 1 to 2 week horizon, we've identified two primary strategies. The long strategy involves buying on dips near the 149.00 support level, targeting the 150.90 to 151.22 resistance zone with stops below 148.55. This offers an attractive risk-reward ratio of 1 minute and 2.5 seconds. Alternatively, the short strategy recommends selling on rejection from the 150.90 resistance level, targeting the 148.00 to 148.50 zone with stops above 151.50. Providing a risk-reward ratio of 1 to 2. The chart illustrates both bullish and bearish projections for the coming weeks. Looking at the medium-term outlook over the next 1 to 3 months, we see two possible scenarios. The bullish scenario, which we assign a 70% probability, targets the 152.00 to 154.00 range. This assumes continued strong US economic data and a cautious BOJ. The strategy here is to buy on dips to 149.00. The bearish scenario, with a 30% probability, sees US dollar to Japanese yen falling back into its previous range and potentially testing the 146.00 to 146.30 support zone. This would likely require weaker US data or a more hawkish BOJ. The strategy here is to sell on rallies to 150.00. Several key risk factors could impact US dollar to Japanese yen trading. Upside risks include stronger US economic data and a continued dovish BOJ stance, both of which would strengthen the dollar against the yen. Downside risks include potential Japanese intervention as US dollar to Japanese yen approaches 150.00 and weaker US labor market data that could accelerate the Fed's rate cut cycle. Our risk impact assessment shows Japanese intervention and U.S. labor market data as the most significant potential influences, followed by interest rate differentials, BOJ policy shifts, and global risk sentiment. Successful US dollar to Japanese yen trading requires strict discipline. Implement stop losses before entering positions, limiting risk to 2% of account value per trade. Practice proper position sizing by distributing risk across multiple positions. Maintain diligent monitoring of BOJ and Fed statements, as well as key economic data releases. Be prepared to adjust your strategy based on market changes, even if it means taking a small loss. Pay special attention to the 150.00 level for potential Japanese intervention, use trailing stops to protect profits, and consider reducing position size during high-impact news events.